Hello traders, Cousin Vinny coming to you from theclosingprint.com on March 22nd, 2020. In this edition of your weekend video newsletter, we'll discuss the indices, obviously all lower for the fifth week straight, with all of the major tech stocks that we follow lower with the exception of Amazon. Bond stock ratio is at extremes. HYG and junk are bearish. Dow Composite, S&P 1500 and the XII are all bearish, though showing some signs that they might be forming a short-term base. Tick Cumulative did show some signs last week of turning higher on Friday, while the most bullish case is starting to form in NIMO and NAMO as breadth starts to improve, still at extremes, but has been rising over the last few days, moving from minus 158 to minus 18 at one point on Friday. In addition, the New York Stock Exchange high-low is improving, and the S&P equal weight index is at extremes, but starting to show signs of improving as well. We do have the put-call ratio at extremes. That has been fading, in addition to VIX, which did close lower at 66.04. and showing signs that it might be beginning to fade off of that extreme level that we saw last week. With the bullish percent at 1175, that's actually rising from 5% to 11.75% as of the close on Friday. US dollar is at extremes. That continues to be the safety trade of choice. US dollar yen also spiked and followed through for the last 2 weeks. That's showing signs that maybe we'll see a change in direction in the short term. And the British pound US dollar hit extremes as well, all of which showing signs that the US dollar is beating all of those currencies at the present time. Bonds also are very choppy. Yields are choppy. We did see the 10-year and the 20-year and the 30-year yields all moving higher and then fading on Friday, leaving the bond trade in a choppy range. Gold had an extreme drop over the last couple of weeks. Copper did start to bounce. That's showing some bullish signs. And the West Texas crude did see a bearish drop over the last 11 weeks, amounting to about 70% off the highs. We need to see that reverse if we have any luck. S&P 500 sectors are all neutral to slightly bearish. There was some green, and the international markets are looking more neutral to bearish as well. We'll look at some IBD 50 names. Believe it or not, these are starting to look better, in addition to some MarketSmith Growth 250 relative strength names that are moving higher. The ones highlighted with an asterisk are a couple of stocks that you might want to take a look at, special interest in. Bulkowski had 5 of 5 red last week, again, with his CPI signal red since March the 20th at 31%. That's still neutral to bearish, with 6 bearish patterns, 0 bullish patterns, and 140 patterns waiting for a breakout. Bottom line, we're cautious. We have a lot of cash. We're watching institutions, what they do, and we're looking for the international markets to show some signs of a bottom. The S&P 500 weekly, 5 weeks straight down, 32%, 33% on the drawdown, showing some signs of short covering towards the end of the day, with the likelihood of a bounce becoming more and more probable as we are way oversold, and MACD is at extremes along with standard deviation stretch from the mean as NIMO and NAMO start to show signs that there is buying. For the New York Stock Exchange, McClellan is starting to show signs of a turn. Higher lows in the NIMO indicator over the last few days. We did see a close at minus 51. We did hit at the highs of the day on Friday minus 18 before reversing, while the McClellan oscillator for the NASDAQ gives us the same sort of look. The descent is starting to decelerate. NAMO is starting to rise. We closed off of the lows of the week at minus 42. While the individual breadth thrust indicators of advanced decline percent are off of the extreme lows, the S&P 500, mid caps, small caps, and NASDAQ 100 in the lower panel, things are starting to improve a little bit at a time, with a lot of stocks that we'll cover in a few minutes looking a lot better than most would think. We also need to pay attention as the NASDAQ 100 has yet to hit the 2018 lows, as S&P already has, while RSI is nearing oversold. The worst, of course, being the small caps getting hit. A lot of stocks, small cap stocks in the oil and gas industry, with the index off over 44%, with RSI oversold, showing some signs that maybe we'll get a bounce in the short term. The NYSE without candles also shows the 50, 200-day in a death cross, which could lead to more downside, while still expecting we could see a short-term bounce over the next couple of weeks if conditions do improve, where we might see VIX continue to drift lower. This is the key, in my opinion. If we do see volatility start to taper off short term, there is a possibility we could fade a bit more and then spike one more time before making a bottom. While that would have some of these extreme indicators like the put-call ratio continue to drop back down towards the mean near the 1 level and give the indices a chance to bounce, as we can clearly see in the New York Stock Exchange new highs minus new lows. This is starting to turn. I'm looking at the black line. As this starts to turn and head towards the zero line, we might surface briefly, at least enough time for us to get a short-term base forming and give us enough time for the New York Stock Exchange advanced decline to start to turn back up. Looking for a lot of stocks in the healthcare group that are working feverishly to try to fix this current crisis with this coronavirus, working 24 hours a day, 7 days a week to try to come up with some sort of solution and a vaccination program for the masses. Additionally, if you look at the S&P equal weight index, where no stock is more important than any other, we did stop at these lows. We have 1.2% of stocks trading above their 50-day moving average, which leaves over 98% stocks below their 50-day moving average. The 200-day is just as bad, with about 97% of stocks trading below their 200-day moving average. All of these are pointing to and suggesting a potential turn in the short term as we look for a base, maybe a double bottom, looking for a trigger, a follow through, more stocks start to rise off of these extreme washout conditions, maybe bounce up to this one level and these previous lows from 2018 before getting rejected again. We have a zone here indicated that we're watching in the short term. If we do get a bounce and some relief, the one thing that I have been thinking about lately is the 2000 bear market, where we saw a weakness that took the S&P 500 10 quarters to resolve before we reversed, while the 2007 bear market took 6 quarters. In 2007, from top to bottom, it took 17 to 18 months if you count March 2009, the reversal month, where we started the current secular bull market. The period from the 1987 crash to the highest point in 2000 is more similar to the current secular bull market as far as duration is concerned, from bottom to top before peaking. So we're only in the second month of this decline. If we do bounce, there is always a possibility this could last for much longer than people are planning. So hedging and planning properly is very important. That said, we are going to stick with our hedges for the short term until we start to see some signs of a bounce, as these inverse ultra short pro S&P 500 and NASDAQ 100 hedges continue to work. We'll look to sell some covered calls at the highs to help finance this particular hedging effort while we wait for a base to form. The bond stock ratio in the bottom panel is at extremes. We're looking for a reversal. High yield corporate debt and junk bonds are also at extreme lows, looking for a bounce. While the 10-year yield did follow through on its move off of the lows last week as well. Looking for oscillators to start turning in the short term with a backdrop of the Fed buying bonds in the repo market on a daily basis. We're starting to see a lot of choppiness, a bounce in the 20-year bond TLT, while RSI did fade off of overbought territory short term. So there's a lot of choppiness in the bond market as well, with AGG giving back more than 50% over the last 2 weeks from the October lows back in 2018 up to the recent highs. Another reason why we decided to take some of this position off 3 weeks ago. While the dollar remains the currency of choice for the safety trade at present, outperforming all the other pairs, especially the US dollar, Japanese yen, which, if it continues to move higher, would add credence to a short-term bounce in equities, while commodities have taken it on the chin. We did see copper show signs maybe it's found a bottom, could start to base in this area, which would be good for construction-related names, home builders, and building supply. And gold showing some similar type of basing action where we consolidated back in November and December and then broke out, starting to firm in that area as well with RSI oversold. So if the dollar does start to fade a bit this week, watch for gold to start rising again. And keep your ears tuned for any signs that Russia and Saudi Arabia might come to an agreement. After seeing nearly a 70% drawdown in crude oil prices over the last 11 weeks, we are looking for a bounce and a follow-through over the next several months as the president fills the strategic petroleum reserve, getting prepared for the spring and the summer. Some sectors and subsectors are beginning to show some improvement. Pause the video and check those out. Also, keep an eye on the international indices for improvement this week. Reading from left to right each week, this is updated. So visually, we're just looking for more green and less red and orange. As most sectors remain near their lows, looking for higher lows and a follow through, maybe a bounce back up to the 20-day moving average over the next several days as spring starts to approach. Watching for stocks that might have a potential to get back above the 200-day moving average with RSI oversold and improving, volume increasing, showing that institutions have been picking up shares. MACD should cross, looking for a follow through once it gets above the 21-day and the 200-day, perhaps this week. AUDC, audio codes looking very interesting. Focus Financial, seeing volume last week. Resistance at the 9 EMA. RSI improving from oversold. Looking for a follow through, maybe the 21-day in the short term. Potential target Monday, Tuesday. GoDaddy, website hosting, looking pretty interesting. Moving through the 9 EMA, getting rejected, closing below it on Friday. RSI oversold and improving, looking for some of these stocks to follow through, especially the ones showing above average volume and MACD starting to turn, showing momentum is starting to shift towards the bulls. GSX showing relative strength, holding at the 21-day moving average. RSI is right at 50. Looking for a turn in MACD and the volume to increase. Some of the stocks in the cannabis industry bounced last week. We're watching those. Innovative Industrial Properties, you already know this company's been on the IBD 50 list for several months. It buys and leases properties to cannabis companies for growing medicinal marijuana and in some states recreational use marijuana and cannabis. Looking for this to continue bouncing. Volume was above average on Friday, making it pretty obvious somebody's buying shares. RSI's oversold and improving. If you take any of these stocks, do keep in mind that we'll be looking to sell some covered calls, outside of standard deviation 1 perhaps, to help ensure any short-term downside that we might see while collecting premium if we're holding shares. Lakeland Industry, provider and manufacturer of protective clothing and garments. Buyers stepped up on Friday at the lows, looking for this to continue higher this week. Keep an eye on LAKE. MDC Holdings, RSI oversold, improving. Seeing a bounce on volume. MACD starting to turn. Looking for some of these stocks to confirm institutions are picking up shares if they follow through. 9 EMA's first resistance and then the 21-day over that. And on top of that, you've got the gap to fill. MSCI, same idea. Need to get that above the 200-day. Note the wicks at the 200-day and the 9 EMA. A move above those two levels would indicate bulls have more control. RSI would start rising. Volume has started to increase. Looking for MACD to turn and give us some confirmation if some of these stocks like MSCI are going to follow through. Mimecast, MIME, same idea. RSI oversold and improving. 9 EMA first resistance, then the 21-day. If you think about taking stocks like this, look for stocks that trade options so you can sell covered calls to help ensure downside. Look for $2 or more. Otherwise, it's not really worth your time or effort if you're thinking about selling covered calls on a stock like MIME. Netflix holding above the 200-day. Nvidia just below the 200-day. Looking for that to improve this week, perhaps, as we like to see AMD follow through as well. The latter trading above its 200-day last week. Palomar Holdings in the insurance industry holding at the 200-day. Volume coming in above average on Friday. Look for this one to follow through. Median price stock, looking for RSI to continue rising and price to get above the 21-day for starters. Quidel Corp, this one looks especially interesting, holding above the 9 EMA. Remember, 97% of stocks are trading below their 200-day moving average on the S&P 500, while nearly 99% are trading below their 50-day moving average. With a stock like Quidel trading above all of its moving averages, helping it stick out, it is a company that provides rapid diagnostic tests for infectious diseases, women's health, and gastrointestinal diseases. So no doubt this one will continue to rise, most likely, as many of these healthcare infectious diseases related stocks continue to show relative strength, trading higher on above average volume with decent annual sales and earnings and good IBD metrics, reporting in the first week of May. Regeneron appears to be forming a base up here. Looking for a follow through similar to what we saw with mRNA last week. Very unusual development lately. A lot of these shipping bulk shippers have been showing relative strength above their 200-day, trading right around the 9 and 21-day moving average. Keep an eye on these. TNK we talked about last week as well. While Zoom Video is probably the number one stock that everybody is trading right now, look at the volume. This most likely will continue to move higher. Hopefully its infrastructure doesn't fail in the midst of this crisis, but other than that, this stock is really doing quite well. And we'll most likely see its sales really increase a lot greater than what was estimated for the year, considering no one saw this coming. With good IBD metrics, above average volume, doesn't report until June. RSI line is rising at 98, looking very strong. In addition, make sure you check out these names under the MarketSmith relative strength heading and the stocks in green, trading higher on above average volume. Many of these look really good and should be considered for potential trades as well, like Xair, which showed some relative strength last week. higher on above average volume. Beyond Air, Calmaine Foods, this one's looking pretty interesting as well. All of these stocks showing above average volume. Relative strength line climbing while the markets are correcting. It's a good list as well. Keep an eye on some of these names that are showing most promise, the ones with asterisks in particular, so keep an eye on those. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com with your weekend video newsletter. Thinking of everyone as we go into this next week of trading. Hopefully we get a nice little bounce. We are cautious. We won't put money to work until we wait for the opening range to see how institutions are going to position this week. Otherwise, wait for the watch list that'll come out later tonight around 11:30 on the East Coast, 8:30 on the West Coast. I'll leave you with this. I don't plan on letting fear take over my life. So one thing I do have control over. The rest of it, we're trying to make it through day by day. Look for institutions to confirm any trade that you're taking. You want to see volume and price rising. Otherwise, you can just sit this one out. If you're worried about your retirement accounts, you can always hedge with SPXU SQQQ like we've been doing lately, and just sit on the sidelines and wait. Take care. I hope this helps, and we'll talk to you soon.